Hello and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Deepak Agrawal, CIO Debt, Kotak Mahindra AMC. Welcome, Deepak. So let's start from where it all began. So after completing your CA, you chose to focus on fixed income rather than equity. Can you please tell us what drew you to the fixed income space?
Basically, see, I am a chartered accountant and I started in Kotak Mutual as an industrial trainee. And at the same time, I was also looking to do an MBA. But in the interim, there was opening the fund management team in the fixed income department itself. Typically, let's say chartered accountant in 2000s used to get less opportunities in the fund management space. So I grabbed the opportunity when I got in the fixed income side. And then over a period of time, I have learned the tricks of the trade and tried to understand the market better and deeper. And that's how, and probably uh, fixed income markets also excited me. And over the journey, basically, let's say I've seen multiple crises like global financial crisis and a currency crisis, and then the COVID crisis. So the journey has been exciting. So yes, my entry into fixed income was by chance. It was not by design, but the journey has been very good.
Deepak, as you rightly mentioned, you had joined Kotak AMC first as a trainee, then as a in the research team, and later taking on the fund management responsibilities during the 2006-7 period. And you have seen multiple like with COVID crisis, global financial crisis, taper tantrum. So, what are the key lessons you have learned over the period of time while managing the money?
So basically, largely the learning has been on the job, and through the various experiences which I had during basically handling the fund for last now let's say close to more than 15 years. And I have experienced the global financial crisis, currency crisis, and let's say the credit crisis, which started from 2018 onwards. So let's say starting with global financial crisis, in a short period of time, we saw significant outflow from the country. And during that time, our AUMs had also reduced significantly. And in most of our short duration schemes, probably at that point of time, industry was running relatively higher duration. So managing liquidity at that juncture was a key factor, and we realized the importance of overall liquidity in the fund and liquidity of the instrument as well. Then during the currency crisis, we realized how important currency is also, and how, let's say, important is that the country runs a lower current account deficit. So its dependence upon capital inflows are relatively lower. Right from 9 to 2012, our current account deficit was building up, and the currency was more or less stable. So also realize the fact that, let's say, if you are running a current account deficit, it's better to depreciate 1 or 2% every year rather than have a very steep depreciation in a short period of time. And what it finally resulted in during the currency crisis, that in order to stem the currency depreciation, the central banker had to raise rates by 300 basis points. So something new. So now going ahead in our analysis, we always take into account what is the currency movement, and whenever there is a sharp depreciation in currency, we are watchful and we would like to hear what is the RBI governor commentary. Coming back from ILFS crisis, how important credits are there in the portfolio, how suddenly the entire liquidity in the entire NBFC segment as a whole can get choked. And let's say if you are doing a particular credit lending on an assumption that your credit is going to get refinanced. So obviously, apart from doing the credit analysis, but you also believe that it's a decent credit and this particular credit should not find it difficult to get refinanced. But what happened in 2018 crisis? The entities which were supposed to refinance that particular credit, they themselves were finding liquidity issues. And therefore, your assumption of refinancing of credits became a big question mark. Obviously, good thing that the ILFS crisis happened. So that let's say September 18 till March 2020, in your credit strategies, you were building liquidity into your portfolio because the credit environment was relatively weak. whenever your credit assets matured, you replace them with AAA assets or good quality assets, liquid assets, and which actually helped you in 2020 when the COVID crisis struck and the concerns on credit and the underlying liquidity for credit assets had dried up significantly because we had increased the AAA allocation to the portfolio. We were able to meet the redemptions during the COVID period. So I think we are students of market on a daily basis, and through each and every episode, though your job is to be proactive, identify. See, finally, in fixed income, there are three risks: credit risk, liquidity risk, and interest rate risk. And my profile is to identify those three risks ahead of times and to ensure that you are not at the extreme end of these risks at any point of time.
Right, those are the lessons learned, as you mentioned. But when it comes to selecting different debt instruments, what's your core investment strategy?
So let's say first is, let's say you form an interest rate view. Based on your interest rate view, then you decide the segment where you intend to buy across the curve, whether you intend to buy in the 2 to 3 year space, 5 to 7 year space, the 10-year space, or the 30-year space. So based on the view, you form you form a view whether you want to run a higher duration or lower duration, and you also identify the attractive segments across the yield curve. Then, depending upon the relative spread between, let's say, a government security and a state government security, and let's say a corporate bond, depending upon the relative attractiveness of the spread and your view going ahead, you will choose allocation either in government securities or in corporate bond. And similarly, within corporate bond space, if the scheme has a mandate to invest in sub AAA assets, then depending upon the spread between, let's say, a AAA asset and a AA asset or a AA minus asset, depending upon the spread available, you may choose the decision whether you want to invest in AAA asset or AA minus asset. So that's the way you go about it. You form a view whether you want to run a higher duration or a lower duration. Once you have made that decision, then you look at the shape of the curve, which segment within the curve you want to invest. And the third point is, let's say you decide between sovereign and non-sovereign assets, and within non-sovereign assets, based on the spreads, you decide between, let's say, a AAA asset and a AA rated asset. That's the way we go about selecting a particular. Now, within the corporate space, obviously, we have list of corporates where we continuously evaluate the credits, and we have credit limits in place. And then based on the spreads, we will be selecting those securities.
You co-manage around 12 schemes at the fund house, which is quite a responsibility. How do you manage to distribute the task and strategize across these funds respectively?
See, basically, let me divide the entire spectrum. Let's say a few strategies, let's say where I am a fund manager, maybe let's say an overnight fund, where the decision is to deploy that money optimally on a daily basis. So I have my entire colleagues with me who are also co-fund managers in most of the scheme along with me. So liquid fund is practically deploying money in an overnight market where we try to optimize based on our estimate of liquidity for that particular day. Then if I refer to funds up to 1 year duration category, let's say a liquid fund, money market, ultra short or low duration. As the tenure of the fund increases, the volatility or the daily inflow outflow in these funds also keep on reducing. So largely the daily inflow outflow, maximum daily inflow outflow you see in liquid fund and overnight fund. There also you have broadly decided or you have guided your colleagues or dealers as to which segment we are looking to buy. Let me divide fund management in two parts. One is cash management and another is portfolio management. So liquid and overnight and to some extent money market, there the activity may also result, maybe a function of cash management in that particular fund. In rest of the fund, let's say we are in a scenario where we believe that interest rates are likely to trend lower. And let's say in GSEC, apart from rate cuts, the demand supply is favorable, that you intend to run a higher duration. So once you construct a portfolio, and the way we go about selecting a particular security, I've covered in previous question. Once you have constructed a portfolio, unless your view changes, you're not dramatically changing the portfolio. So I would say month on month, 90% of the portfolio is likely to remain constant on a month on month basis. So cash management is something where activity may happen, and rest of the portfolio, based on your view, largely the portfolio is going to continue. Apart from that, let's say if there are some new issuers in the market, then you will evaluate those credits. There is an entire credit research team which meets the management, interacts with rating agencies, does do their independent research, and finally they propose a particular investment limit which gets cleared from the investment committee. So credit work is separate, which is parallelly happening, and your work is divided into two functions. Cash management happens regularly, and the balanced portfolio remains more or less constant month on month basis unless your view changes. This is the way probably we go about fund management.
All right. And for investors looking to pick just one or two versatile debt schemes, like an all-weather diversified fund in equities, which ones would you recommend?
Basically, the duration is dynamically managed across all schemes. But the maximum, let's say, duration, let's say a gilt fund, even though the word dynamic is absent from a gilt fund also has that flexibility of taking the duration down to 2 years and taking the duration as 11, 12 years. So gilt and dynamic both have the flexibility to increase, decrease duration. But the difference between gilt and dynamic is a gilt fund, 100% of the portfolio would only be invested in sovereign, whereas a dynamic fund can take 100% exposure to corporate bond as well. So by having a flexibility to invest 100% in corporates, over a longer period of time, the portfolio ITM of a dynamic fund is likely to be higher than the portfolio ITM of a gilt fund, and due to which a dynamic fund has a relatively higher probability of outperforming a gilt fund because of its ability to invest in non-sovereign assets.
The next question is on dynamic bond fund only, which has given around 10.3% return in the last 1 year. And as you mentioned, it allows you to move between the various investment period. The average maturity of the fund is around 21.6 years, which is slightly higher compared to the category. So are you which indicates that you are anticipating the rate cuts going forward?
Last week on Friday at Jackson Hole, Powell has guided that time has come for rate cut. Powell has, so again, first week of September, we'll have the jobs data for the month of August. If the job data is weak, high likelihood that we get 50 bips cut in US. But we are not only looking from this one policy. Based on the likely inflation projections for next calendar year, currently the real rates in US are close to 250 to 275 basis point. So we believe that because Fed has achieved a fantastic job of soft landing, and because inflation has come down, Fed is likely to bring down the real rates from 250 to 275 basis down to 150. So reducing real rate from 250, 275 to 150 gives leeway for Fed to cut rates by 100 to 125 basis points. In addition to that, next year inflation is likely to be lower by 50 basis points. So we believe from here till December 2025, there are cumulative cuts of close to 150 to 175 basis points in US. In India also, we believe that RBI is likely to cut rates in the second half of this year and over the course of next 1 year. Our base case is that RBI will cut rates by 50 basis points. There's a likelihood that if there is further global easing, then RBI may also cut rates by 75 basis points. So one, we are working with rate cut assumptions. Second, if you look at the domestic demand supply, the domestic, for last 3 years, the domestic supply of GSEC has been more or less constant, whereas the domestic demand of GSEC from insurance companies, provident fund, banks, that is increasing year on year. In addition to that, RBI has come out with a guideline where banks may be asked to keep additional GSEC or they'll be asked to maintain additional liquidity coverage ratio, which will lead to an incremental demand for GSEC to the tune of anywhere between 3 to 3.5 lakh crore. So the domestic demand supply is in favor of, let's say, bond yields coming down. Now, in addition to that, we had the JP Morgan index inclusion last year. Approximately $25 to $30 billion is expected on account of this inclusion. From September till date, we have seen close to $12 billion flows into our GSEC market already. Now, assuming that $10 billion has come on account of index and $2 billion others, an incremental $15 billion is likely to come in fixed income market between now and March 2025. you may get additional $3 to $5 billion on account of India's inclusion into Bloomberg Emerging Market Bond Index. So let's say if I assume $3 billion on account of that and balance $15 billion on account of JP Morgan, so you get incremental $18 billion flows from year till March 2025 or year till June 2025. So domestic demand supply is favorable. In addition to that, you have global demand, and plus you have rate cuts. And plus, let's say fourth point is government of India has guided for sub 4.5% fiscal deficit for FY26. We think high probability that the combined fiscal deficit of center plus state put together is closer to 7% or 7.2% in FY26. S&P has indicated that if the combined fiscal deficit is closer to 7%, high chance of an India rating upgrade. So all these factors put together makes us believe that the long-term rates are likely to trend lower. And we want to take the benefit of long-term rates trending lower. And therefore, we are running higher duration in our funds.
But Deepak, is it possible due to the geopolitical situation or some black swan event kind of thing? Don't you foresee some risk which could, because it's a really high duration, so it might not lead to some volatility?
So again, typically when we one is investors should select funds based on the recommendations of their investment counselor, and typically we suggest investors should select funds based on their investment horizon. We believe investors should come into a dynamic fund. Those set of investors should have at least 1 year investment horizon. Yes, volatility would be there, but we believe at current juncture, it does make sense to run this kind of duration. And it is we believe that based on our view, there is merit in running higher duration. And investors having minimum 12 months investment horizon, and based on the advice of their investment counselor, can look to invest in long duration in our dynamic fund and long duration fund. So it's not that we are not asking investors to invest in a short duration fund or a medium term fund. In fact, investors who prefer low volatility can consider a medium term fund or a short duration fund like corporate bond, banking, PSU. These funds are currently running duration on an average close to 3 years. We believe that with rate cuts, the yield curve, which is currently flat to inverted, is likely to steepen. And let's say on a 50 basis point rate cut, we expect we are expecting, let's say some rate cuts are already discounting, some easing is already discounting. So if we work with a conservative assumption of 30 basis point drop in 3-year yields on a 50 basis point easing, that can result in a approximate capital gains of close to 1%. Now today, let's say a short duration fund which has portfolio yield close to 7.5%. That means that the gross return of short duration category could be close to 8.5%. And let's say a medium term fund which has a portfolio yield closer to 8.25%, there the gross return could be in the band of 9 to 9.5%, assuming on a 50 basis point rate cut, we are seeing close to 30 basis point drop in the yield curve.
Since the announcement of sovereign bonds being included in the JP Morgan Emerging Market Bond Index, 10-year government bond yields have fallen and are, they're now near the year's lowest. So with an inclusion rate of 1% per month over the next 7 months, do you expect yields to slide further, or is this already factored into bond prices?
See, as I mentioned, that the domestic demand supply is favorable. In addition to that, the RBI LCR guideline is under basically right now under consultation. Once the guideline takes final shape, and unless banks are given more time to comply with the guideline, there will be an incremental demand for GSEC anywhere between 2 to 4 lakh crore starting 1st April 2025. So let's say we work with 3 lakh crore number. So that also results in incremental demand. And you have JP Morgan flows. So rate cuts combined with demand exceeding supply. Yes, we have seen easing in our yields from, let's say, last year, same time we were close to 710, 715, and currently we are at 685, 690. So over last 1 year, we have seen close to 30 basis point drop. But because the favorable demand supply scenario is likely to continue, potential rating upgrade along with rate cuts. And right now we are working with only a 50 basis point rate cut. Given the fact that globally we are going to see 150, 175 basis point rate cut, I may not rule out a 75 basis point rate cut in India. And therefore, it's quite likely that the 10-year GSEC, which is currently trading in the band of 685 to 690, probably 9 months down the line, it is in the band of 6/4 to 6/2.
Deepak, you mentioned all the positives for the debt market, like JP Morgan index, interest rates coming down. Can you just explain elaborately how do you see this impacting overall in the debt market?
No, so the way I told you, investors today can one is liquidity in the system has improved. Again, one thing where we are not currently in my argument, I am not right now. We are assuming that the growth will continue to remain strong at 7%. Last week, Goldman Sachs has revised calendar year 2025 growth lower at 640. So when I'm working with a 50 basis point rate cut assumption, I'm assuming that our growth continues to remain strong at 7%. But if growth let's say growth reduces anywhere between, let's say, 6/4 to 6/2, that may also be one of the reasons why RBI can go ahead and cut rates. So one liquidity. So basically, the impact of these rate cuts would be one is if US is cutting 200 and we are cutting, let's say, by 50, 75 basis point, the interest rate differential between India and US will widen again, and dollar rupee will continue to remain stable. Number one. And let's say if you ask me what's the dollar rupee view from here till March 2025, we believe dollar rupee largely because once Fed start cutting rates, probably apart from debt flows, we may also start getting flows in equity. And nowadays at 84, a 1% depreciation is close to 84 paisa. So basically, even if rupee depreciates from 84 to 85, it's not a very big depreciation. But our view is that from here till March 2025, largely dollar rupee is likely to trade in the band of 83.50 to 85. Liquidity in the system is easy. Liquidity in the system is likely to remain easy. With rate cuts, the yield curve is likely to get steep. As I mentioned earlier, that on a 50 basis point rate cut by RBI, since some discounting of rate cuts have already happened, we can see at least a 30 basis point drop in yield across the yield curve. Let's say right from, let's say, 3 months up to, let's say, 5 years, the yield curve is likely to get steepen. Long-term rates, because of favorable demand-supply dynamics and along with rate cuts, a 10-year GSEC, which is currently around 685 to 690, can come down to around, let's say, 640, 650. So corporates, again, finally, if currently, and finally, higher liquidity rate cuts will also bring down cost of borrowing for banks. And it should also translate into, let's say, a 50 basis point rate cut should at least lead to 25 basis point reduction in case banks reduces their MCLR rates. And most of the corporates are also now borrowing linked to repo rate or linked to external benchmarks like 3-month T-bill, where rate cuts will lead to drop in these rates. And finally, it will also translate into lower borrowing for corporates.
How do you see this everything impacting the gilt funds? Do you foresee more returns in the gilt funds compared to the other funds, or how do you oversee the gilt funds at this point of time?
As mentioned, let's say a medium-term fund, because let's say a gilt fund today has the portfolio of ITMs are close to 710, 720, whereas a medium-term fund has a portfolio of ITM in the closer to 8/4, because it is also investing in sub-AAA assets. Now, so let's say for a gilt fund to basically outperform a medium-term fund, the extent of drop has to be either similar or more than the extent of drop in the medium-term segment. So based on our assumption, let's say that there is equivalent extent of drop both in the 3-year, 5-year space and close to 30 to 40 basis point at the longer end. We believe that because of higher duration, a dynamic fund or a gilt fund can end up outperforming a medium-term kind of strategy over the course of next 1 year.
Now, you've already mentioned a versatile debt scheme. You mentioned the dynamic bond scheme, but given the current scenario, which debt fund category would you recommend to retail investors for their fixed income allocation?
So let's say I would suggest 2 schemes of ours. One is our medium-term fund, where the current duration of the fund is close to 3.5 years, and let's say where the portfolio items are close to 8/4. This is again one category of fund where investors can look to park their money. And the second is the longer duration fund. In the longer duration funds, currently all our funds, let's say a gilt fund or a dynamic fund or long duration funds, are running duration closer to 10 to 11 years. And based on our view that interest rates are likely to come down and the demand supply dynamics in GSEC is favorable, investor can choose either of these funds. And if they have to select one, probably it's the Kotak Dynamic scheme which they can look to select at the current juncture. So if I have to just summarize two schemes, Kotak Medium Term Fund and Kotak Dynamic Fund.
Given the trending in interest rates going forward, what's your thought on locking the interest rates at this level through target maturity funds?
Again, target maturity funds are good options. So let's say we have a 2033 SDL funds and close to 9-year SDL fund. Currently, let's say a 10-year SDL is closer to the yields are annualized yields are in the range of 730 to 740. So yes, if one wants to, one is, let's say, if somebody is looking to, if you look in a bank FD, the yield curve is inverted. The 1-year FD rates may be higher, but let's say longer 10-year FD rates may be lower. So if one is looking as an alternative to a fixed deposit, then choosing these funds, and one is looking to just invest and hold it till maturity, then locking at these yields is good. One can lock in his funds. Second, let's say, in case of any other traditional fixed income instrument, you have to pay tax every year. Whereas in case of a mutual fund scheme, you pay tax only at the time of exit. Now, due to difference of tax, it results into basically it's add to the customer's return because you are deferring the tax payment since you are deferring your exit. Now, let's say assuming a bank FD rate or any traditional fixed income instrument, and let's say a 10-year target maturity fund, if the portfolio of items are similar, because of deferral of tax over a period of 10 years, the effective yield increases by close to 60 basis points. So yes, there are merits. One, yield curve is inverted in FD. You get a higher rate in a target maturity fund and at this juncture, it makes sense to park the money and lock in the money for a longer period of time. Plus, there are tax advantages as well.
Right now, Deepak, before we wrap up this chat, one last question. Kotak Bond short-term fund had an average 2023, but it seems to be having a pretty solid 24. What's been working well for the fund this year, if you can elaborate on that?
So one, we have increased the duration of the fund. And so basically, let's say we for last 3 or 4 months or 5 months, we are running the duration closer to at the upper end of the range. Closer to 275 3 years. In addition to that, the fund also had close to 10 to 12 to 15% exposure to floating rate sovereign assets. Because there was uncertainty at the start of the year, there were expectations that Fed will cut rates by 150 basis points. Then suddenly by April, those expectations had receded to 50 basis points. In June, the expectations was that there will be only 25 basis point rate cut. Because of this volatility, the floating rate bonds did well in first half of this year. And subsequent to that, when post the LCR guidelines, where banks may be required to buy these at incremental amount of GSEC as a LCR requirement, that has also resulted in further in outperformance of these floating rate instruments. We believe that our allocation to these floating rate instrument has been higher vis-a-vis our peers, and that has aided in the scheme performance.
Okay, with that, we'll wrap up this chat for today. Thank you, Deepak, for taking the time for this interaction. It was good having you here.
Thank you. My pleasure.